Great. Thanks for everyone to come back to this series. This is a new starter of a new semester. We're happy to have Rob Townsend from MIT to kick off this series. The topic is delegation of programmable contracts to the private sector. Is there a role for the public sector? The plan will be Rob will talk without interruption about 35 to 40 minutes. And then we will open up the discussion. Please add your questions in the Q&A session, and I will try to organize. Rob, the floor is yours.
Thank you so much. Thank you for inviting me. Yeah, Zhiguo has mentioned the title, Delegation of Programmable Contracts to the Private Sector. Is there a role for the public sector? Really appreciate the opportunity to present this overview of various work in progress. There's a lot of threads here. I'm going to give some background on this private-public issue with regards provoked by CBDC, and then I'll talk about smart contracts and programmability with and without distributed ledgers. Then I'll launch into the heart of the talk, which is delegation to the private sector, what we know in terms of competition and outcomes, touch on financial stability concerns, but propose a remedy. Nevertheless, there are sort of rules of the game for playing field that I'll need to go over. There are always concerns in standard and non-standard setups about limits to competition, economies of scale, incomplete markets, externalities, and so on. And I will deal with each of those one at a time on individual slides. Then we come back to sort of the CBDC issue, which what's the role for a public bank, in particular, potentially CBDC, when there are a few financial intermediaries. Another role is smart contracts as used in regulation. So regulators need this, not prevent it, but with the right rules. And also relatedly, information design and data infrastructure comes up, and I'll conclude with some comments on what I think is the heart of the issue surrounding CBDC, which is money and monetary policy. Okay, so let me come back to the background here. There's a lot on this slide, and I'm not sure exactly how familiar the audience will be with all of this. What about CBDC? If CBDC is launched on distributed ledgers, there are some problems, namely these validation protocols, notoriously Bitcoin, but on the blockchain in general, it doesn't scale up very well. Now, there are better algorithms increasingly, but one thing I want to highlight is the confusion with the terminology smart contracts and Ethereum. Ethereum runs on a distributed ledger, it's basically based on Bitcoin, but it is not needed in order to write smart contracts. Is CBDC needed at all? Well, various countries, Brazil, India, and so on, are improving their payment systems initially without CBDC. PIX in Brazil, this UPI in India. These are payment systems, so it works on debiting and crediting balance sheets in banks and other financial service providers. It is not run on a distributed ledger. It's digital, but otherwise doesn't have much of a connection to many of the new tools that we have. PIX, for example, in Brazil, allows buyers and sellers with shipping of goods added on with invoice financing, which effectively changes the recipient of the funds because the account receivable is sold. So that's a bit more of a complication for PIX, and they're working on that. Delivery for payment for assets like cars and real estate is another thing they're planning to have in open banking, although again, that could interface with existing digital authentication platforms. Multi-party is more difficult, and the worry with PICs and open banking is that they're developing one application at a time, and it's not clear yet if there are going to be limits rather than designing the system from the get-go. So another way to do it potentially is to have an open platform for infrastructure that allows contracting, allow anyone really to write and execute contracts, multi-party arrangements. An example of this is a fintech in Thailand, EveryNet, that has no connection to a central bank at all. So again, another distinction here, you could have open platform for contracting, in this case, provided by the private sector in Thailand, but it could be provided by the public sector. And that's another option for Brazil to facilitate contracting, much in the spirit of the way PIX facilitates payments. What's unclear yet is having multiple private sector platforms. They would need to be interoperable with each other. There are some key wonderful examples, hashed time lock contracts, but it's not clear yet, in my view, how general that technology can be applied. So then we come to a hybrid, which is contracts, yes, but separated from CBDC in the sense that the code for the contract runs independently, but the instructions would dictate eventual transfers, which could happen on the ledger or could happen with a trusted third party. So yeah, long-winded introduction, but the point is this slide envisions various ways in which a lot of the work is delegated to the private sector, and the question is whether this is sensible, and particular role for the public sector in this context, rationales or not for CBDC and so on, which I get to again toward the end. So I've used this language before: smart contracts, programming, etc. So just think about a mechanism design problem. We're going to maximize a weighted sum of the utilities of the participants subject to resource constraints, information constraints, limited commitment constraints, participation constraints, and so on. We know how to solve these problems. Because of the incentive constraints, agents will have an incentive to tell the truth and likewise have an incentive to take specified actions and follow recommended plans. In fact, to put it quite bluntly, no further validation is necessary when you're implementing a mechanism design problem because you've loaded all the incentives into it internally. So smart contracts should be viewed as code. They're just coded instructions to execute applications and solutions to mechanism design problems. It's not really related to distributed ledgers, as I've said. It could be part of CBDC in terms of the final value transfers as an option. Now, cryptography is a key part of this. Privacy for incoming messages, for outgoing messages using signatures, that also generates commitment. Prime example, again, are these hashed time lock contracts called trustless escrow services. That's sort of an ironic terminology. And with this cryptography, you can essentially start thinking about the whole design of data in terms of the option of keeping everything private, but encrypting and then running things on the system so no one else sees anyone else's messages. Although you may want to open up part of it, that's part of the endogenous design. So as a consequence of thinking about things this way, you can deal with strangers. You don't have to deal with trusted third-party intermediaries. It's much in the spirit of this enhanced vision for decentralized finance. You have the potential of more efficiency, of flexibility, and the potential to reduce rent extraction. So hopefully this schemata tells the story. You have the coded smart contract here. You have agents, in this case A and B, with their balance sheet and other ledgers. They're engaged in other actions potentially, and there's some unobserved states. They're going to send messages that end up in the smart contract, but there is no planner. There is no mechanism designer. It's just code. And with the encryption, it is possible that the message sent by agent A is not seen by B and vice versa. Nevertheless, the code at the end of the day dictates the transfers. The transfers could be done on ledgers, distributed ledgers. The transfers could be in terms of central bank digital currency, and that closes the loop back to the balance sheets. So with Nicholas Zhang, I have work on this, how to design auctions to run without auctioneers, what we call a hybrid flexible borrowing and lending insurance arrangement is executable, where it's really important to keep these messages that agents are sending to the code secure and private from the other agents. And you can start thinking about designing, needed financial and information infrastructure as for small and medium enterprises. Okay. So again, back to the heart of the talk, does this vision of allowing the private sector to be creating and writing the smart contracts, does this vision make sense, or are we going to run into problems? What do we know from economic theory about the outcomes of such a process, where broker-dealers, platforms, and so on are competing with one another, not restricted to commercial banks, open and free entry? Well, intermediaries are specifying terms of trade, rates of exchange to buy and sell assets and commodities. There are two ways to accomplish the objective of achieving as an outcome the equivalent Walrasian Pareto optimal allocations. And the first way of doing it, potential customers can choose one of several platforms, which means that if the platform announcing prices, and they're different, then there's an arbitrage opportunity, which means the intermediary would run out of assets or goods. So therefore, prices announced by these active platforms would have to be the same. And then the next step is, well, then I would prefer to be a customer trading what I want at an announced price rather than being an intermediary absorbing the aggregated residual from the others who have those choices. So you put those two ingredients together and voila, you end up with the competitive outcome very quickly with two or more competing platforms. There is another way to do it, which we're going to need in a minute, which is customers can choose only one platform, choose among several, but only one. But this can also work in the limit as we get more and more participants. Because if the trial equilibrium is not in the core, then it can be blocked by a coalition, and particularly it can be blocked by an intermediary calling out prices to attract customers. So in the limit, with the core shrinks to the competitive equilibrium as the economy is cloned with more and more agents of given types. So this is good news, maybe not new news, but a good review. Now, when we get to the contracts, it still works. So if you have in mind like a Diamond Didvid banking model, there's kind of a banking contract where customers announce whether they're patient or urgent to consume, and those shocks are private. Agents have to be given incentives to announce truthfully, depending on what they're going to eat today and eat in the next period. One could imagine a competitive equilibrium with competing broker-dealers offering contracts to customers. Again, could be banks, could be other non-bank intermediaries, and they're going to be doing some pooling. It's a bit like securitization, because the contracts, the Diamond Didvid contract, have options. So the intermediary, can count on a certain fraction of people saying they're urgent, another fraction saying they're patient, and that process of competing intermediaries in the space of contracts gets you to the competitive outcome. It's really just converting notation from contracts into standard commodity space, X for consumption, Y for production, and so on. So the core shrinks to the competitive equilibrium, so these intermediaries would be able to compete for customers and get us very close, arbitrarily close to the frictionless outcome, although it's still private information. Okay, so speaking of Diamond Didvid, what will come to mind are runs. And this is a rationale for regulation and other things. But Green and Lin have shown how to implement efficient allocations that mitigate, or in some cases actually eliminate, the runs. And you can code all that up with cryptography to keep privacy and get the Green and Lin solution. So here we're sort of beginning to go back to a role for the public sector, but in this case, it's a sort of a regulatory role to make sure that the private sector are building these systems that mitigate the runs. So it's a design issue rather than having the public sector invoke other, more familiar brute force regulations. Okay, so we get to some caveats about competition. So this is not like anything goes, don't give me a rule. I have freedom, I'll do whatever I want. No, ex-ante competition is good. That's what I've been describing. But ex-post competition for customers who are already being serviced by a provider is not. This lesson we know from Jacqueline, among others. Again, in the context of the Diamond Didvid model, it's important to not allow customers to deal with each other on the side, because otherwise they would not join the bank and undercut the intermediation. This is possible with today's technologies. If you require that exchanges be done on ledgers and so on, then in principle, it can be monitored. Which is to say, you don't have a claim on something if it's not executed on the ledger. Delegation is another example. Delegation to an intermediary to manage the entire investment portfolio of clients rather than having clients manage part of it. So the idea here is that if agents can do stuff on the side that's private and unobserved, then it undercuts the ex-ante incentives. Doesn't eliminate things, but it's like second best if you can't monitor it. Ironically, fiat money, paper currency in particular, which is used privately, does undercut solutions to mechanism design problems. And I suppose that's a bit of a different rationale for distributed ledger technology, because then in principle, there's more information and control. But there are implications not just for fiat money, there are implications for crypto if you take this point of view, namely tokens, our utility tokens at least, are good for mechanism design purposes, but a market for the tokens is not good. Because again, that undercuts the use of the coin internally under the mechanism. And there are roles for multiple tokens, colored tokens. Basically, think of money as memory, as Scotch Lakota had put it, but it's also extendable to other situations. Okay, so so there are caveats on competition having to do with ex post competition and data. Another concern with letting the private sector do it would be economies of scale, but that's not always a problem either. Consider, for example, intermediation with costly bilateral exchange. Agents have random endowments, IID. Diversification is good. More and more people in the pool allows better and better risk sharing. However, the marginal gain is decreasing sort of intuitively by the law of large numbers. On the cost side, there's a transactions cost for bilateral exchange. The marginal costs are positive, but as more and more people join the risk sharing group, the marginal costs are decreasing. So it's possible, although not conventional, that marginal costs eventually, though declining, exceeds the marginal revenue, which was also declining, and that will limit group size. So you end up with finite size coalitions in the core allocation, which is one, efficient. And just like I was saying before, with exactly, in fact, this work came first, with exactly the same notion of a decentralized equilibrium, you can have broker dealers competing with one another, calling out terms of trade, and agents choosing which group to join. And you get to efficiency, despite the economies of scale. Now, another concern about competition is incomplete markets. So Makowski and Pessendorfer start with a world in which there are exogenous incomplete markets, but they then allow intermediaries to introduce new securities and sell them to households. A continuum of intermediaries of a finite number of types. So the intermediaries are small and they're competitive. And despite that, the system can get stuck at inefficient outcomes where there are further gains to innovation. The intuition is you need these intermediaries to basically coordinate with one another to take advantage of complementarities. But again, in principle, the new technology could do this with coordinated, coordinated innovations. Can solve the multiple equilibrium problem and and allow the market to become more complete. This is not the way regulators think about the world generally. They put things in silos by product or by service. They separate credit from insurance, for example. Thinking about crypto, they're pondering whether it's a security or whether to control it with bank regulation or think about it as a commodity. So here there is a role for the public sector, to come back to my basic theme, namely public sector having the right improved conceptual framework for regulation. Another concern raised about competition has to do with externalities. In particular, for example, we have what's called two-sided market problems. This is ironic terminology. The utility of the platform of a given participant depends on who else is on the platform, the number and nature of those other people. So it's an externality. Buyers want sellers, sellers want buyers, credit card users want to make sure that merchants will accept them, and so on. This conception of the problem led the Fed under Dodd-Frank to intervene for the first time in setting redemption rates for card issues. But there is a better design, namely to allow the different user types to join the platforms at type-specific fees that cover the costs of running the platform. The vision of credit card companies competing, and of which there are only a few, is too narrow, because now, you know, we have other means of payment like cryptocurrency and so on. Even if there are fixed costs of setting up yet another currency, that turns out not to be a problem if it's a large economy. It's by scaling the number of platforms of a given type up or down, you're eventually scaling the fixed costs. The real problem, but it turns out to be a virtue, are the marginal costs. So increasing marginal costs of larger and larger platforms will ensure that there's a finite number in equilibrium. And that will get you the competitive outcome. But again, we know there are these costs, improved algorithms notwithstanding, for validation of the crypto coins and so on. So it's not unrealistic to imagine increasing marginal costs. Another concern having to do with externalities or pecuniary externalities. I was just talking about non-pecuniary. I'm going to skip this slide and potentially, depending on the discussion and questions, we can come back to it. Another view has to do with aggregates. So if you think about Acemoglu and Zalibati, you know, they have these various sectors, and the issue is whether to fund them or not. And you don't have enough resources to fund all of them. So there are aggregate consequences. Certain aggregate states are not going to get covered under these technologies, which are not operating. So what you need here are intermediaries as go-betweens for funding investments of firms, and then providing to the products to the customers. Customers will want a balanced portfolio, but that's not the right goal. And if they're not required to go through the intermediaries, they would end up doing that and undercut the aggregate. So there is a way to do this competitively, but it's essentially picking the single intermediary who's going to provide these services by having the intermediary compete with others for the right to provide those services, like a franchise. I mentioned this one in particular because all the other examples had small players, small intermediaries, small. Here, there's something going on in the aggregate. So one could imagine this extends to data issues too, you know, hinting of these debates about big tech and fintech and so on. And this is a way to begin to think about those designs. Now, if there are only a few financial intermediaries for some reason, then we start to run into problems, and people are thinking about CBDC as a solution to these industrial organization problems. There are some surprising results. Lowering obstacles in a world with a small number of players can actually hurt the public, because intermediaries can extract more rents. The nature of the problem is quantitative. We really do need to know whether there are artificial product distinctions being created, as in walled gardens, that's really contributing to the intermediary rents. And likewise, the larger gains are to get rid of these artificial distinctions, as in lowering spatial costs, rather than increasing the number of banks per se. the conventional view is commercial banks provide credit insurance and savings products. They act preemptively to prevent innovation. You see that playing out all the time. So the public sector could come in and help provide that missing competition, making the private sector outcome more competitive. There is work on CBDC, among others. Andolfo and Williamson are working on this. But I have a bit of a complaint with it, which is that it largely takes as given that commercial banks are doing the intermediation, whereas with appropriately regulated DeFi, you can have non-bank intermediaries competing. And as we've already said, central bank digital currency can help in that case if it helps with the transfer of value on the as an outcome of the private sector contracting. So I'm not saying there isn't a role for CBDC. Anyway, this slide has to do with thinking about CBDC in sort of an IO few players. Then I want to say that regulators often take a narrow view about whether or not to allow innovation. They're going to protect their legacy system. They believe they can regulate quite well, and they don't know what to do with DeFi and so on. I would switch this around and try to make the case for regulators that they can use this new technology. For example, and hence that's a big role for the public sector, using smart contracts. Many of you may know about Ostroy Star, the impossibility of decentralized exchange, which again has to do with who knows what at a given nodal pairing. Models of circulating private debt that I've contributed to earlier display multiple equilibria, and if it's uncoordinated, you can get financial crises that way. But again, these smart contracts allow coordination across multiple issues of digital assets to mitigate that problem. And for that matter, it's not abstract. If you look at the US repo markets, we're certainly seeing coordination problems, in my view, multiple equilibria problems that regulation has created for liquidity. And those two problems can be solved, as in this work with Dan and Nicholas, with smart contracts. So you can think of it as a regulation recommendation or a design issue. I'm not sure what terminology to use. And coming back to the information issues, there are some surprises here. There's kind of a role in design regulation for the public sector. Credit registry design with artificial intelligence, big data, and so on requires commitment. With that commitment, it may be optimal not to provide to investors all the information that the platform has gathered, because otherwise it leads to an Akerlof-like unraveling problem. Similarly with Michael Lee and Antoine Martin and Rod Garrett, we have some work on broker-dealers, OTC markets, but those trades are sent to a third-party clearing platform, and in principle could be the information aggregated in that way could be sold. It's exactly the wrong thing to do. It's going to exacerbate the adverse selection problem. So you need to control, either give it all away or not let any of it out, or two extreme solutions. Otherwise, liquidity dries up and you get the worst possible outcome. And likewise, atomic swaps are strongly recommended, but it turns out, that can also be a problem in terms of commitment unless you bring in more cryptography to hide trades. So I want to end with money and monetary policy. To me, this is the natural place to think about central bank digital currency, the natural gain. If competitive equilibria is in incomplete markets due to segmentation or frictions or whatever, then you can get valued fiat money, and not only that, optimal activist money policy. Then on top, you can layer in bank deposits, multiple means of payments, and so on, coexisting if the structure remains incomplete with the fiat money. Central bank digital currency would be like that. You replace part or all of the paper with the digital currency. That could potentially enhance monetary policy, not just with programmed interest rate, but programmed in other respects. And then by analogy, once CBDC is out there, you can layer stable coins and that are fully backed and so on by CBDC. So it's a bit like having commercial bank accounts with monitoring, except this can be done by the DeFi industry, pooling resources, maturity, and risk transformation without requiring a trusted third party. So the public sector could facilitate with CBDC that kind of intermediation. And that's kind of a one step back argument for CBDC to encourage and facilitate innovation in the private sector. And there is an international version of this as well, potentially dealing with the cross-border problem, which is well known, and for which we're seeing proposed solutions like MCBDC or depository receipt tokens as an interknown line rock and so on. So I'm going to skip this slide. So I'm done, basically. This is just a quick summary because we covered a lot of ground. The conversations about CBDC beg a lot of issues about how much the private sector can or should be allowed to do. In other words, is there a role for CBDC? We covered smart contracts and programming as distinct from distributed ledgers. Talked about the ability to decentralize using first principles, competition among intermediaries, handled financial stability concerns, had many caveats about the right rules of the game, and answered concerns about economies of scale, incomplete markets, externalities, and intermediation when aggregates matter. So still, private sector is viable. CBDC starts to come back into play when we think about industrial organization and competition among intermediaries with few providers, although there are twists and need, in my view, for a larger vision of intermediation possibilities. Smart contracts and the public sector play a role in regulation and should play a role in information design. And it's not just public versus private information, it's designed with the cryptography. And finally, I just ended with money and monetary policy for domestic and international uses. So hopefully right on time, pretty much. So that concludes my formals remark. I'm gonna
Thanks a lot.
sharing the screen. I can come back and show slides if it comes
Yeah,
up.
it's possible. So I think, Rob, I guess that I give you too little time. Every slide is really dense, and someone in the audience was asking about can you share the slide? I hope you said yes, because I was also try to try to do some screenshot, which is just not enough time to do. So I just take the advantage of the host here. I particularly interested in one in your opening slide. The first, can you show the slides first? The first slide.
Yeah. So let's go back to this. And,
very first. The
this one?
The hybrid. I thought there's a hybrid. Yeah, hybrid. So now when the CBDC, there, you know, I knew many different attempts and also design, also thinking what CBDCs try to achieve. I'm more familiar with the China version, but also others. So often the time that the debate, at least in some of the discussion back in China, is that in what way that can they make the CBDC interoperable with the other kind of blockchains, and in a way that you think that from what I'm reading from this bullet point is basically saying that my imagination is that we have a privately built many good blockchains to achieve many like a real side of the goals, but just the payment side just delegate back to the state or the central bank. Is this what's in your mind? And if I do think that that's a very good outcome as combining the private sector's innovation, private sector's efficiency with the public goods of the money, but do you see any obstacles to achieving that?
Well, that is the vision that I'm saying here. I guess I want to emphasize the programmability and fiat aspect to it, right? I mean, if you have a trusted third party, like say a commercial bank, then you can write code and instruct your bank what to do. So the private sector could enter into contracts the way we buy and sell real estate, right? Money gets put in escrow. So I'm not against that. It's just that in some instances, particularly with limited financial access and in some cases actually lack of trust of commercial banks, there is a way to do this by having the fiat money basically converted to a token, as you just said. So that's where the value transfer, and plus when it's a token, it can be part of the code, so you can program and do more things than just complete the payment. It can be contingent. Where I do see myself wanting to understand better is, like having multiple private sector platforms and the degree to which they're interoperable. I mean, I'm aware, I'm sure you are, of various initiatives that claim to have solved this problem, but I'm not entirely sure that they have. I'm willing, though, to be convinced.
Yeah, so I feel I definitely agree with you that if in the China context where it's just as if it's just a fiat money, like there's an equality between the fiat money and the digitalized fiat money, that should be easier. I think that the debate there was more on like the technical side, which I'm not an expert. But here, probably if you have a multiple platform, think about DM and other things, maybe you need some private sector, gets into resolve certain things. So there was a question I do think that I also want to ask you is that in your mind, what is a smart contract? The reason I ask it, we had a discussion on that. The version that I understand, at least nowadays, right? I understand you're also saying it's a programmable code.
I wanted to draw the distinction because the smart contract that I know is only on-chain smart contract, which means that in my mind is that the kind of like the input. So let's say that we wanna penalize somebody doing bad. The input, which is the evidence of something doing bad, should be agreed upon the whole society, not just simply a message. I don't know if this way of describing it, you have thought about it, or am I missing something?
I thought about it quite a bit. Let me, you're still seeing this, right?
I'm still seeing the first slide.
Yeah.
And yeah, if you can elaborate more on this smart contract, programmable code, what's the thorny issue, I think it will be very helpful.
Yeah, I just want to make sure you're seeing this schemata for financial information designs.
No, I don't. I'm only seeing the background. Let's see, CBDC.
Oh,
Maybe you stop sharing again.
I might have clicked on the wrong thing. Sorry. Hold on.
Okay, that's fine.
For the delay. How about now?
Yeah.
Yeah. Okay. So, granted, this is just an example, but hopefully the diagram helps. So that in this case, there are only two people with their own financial accounts and so on. Maybe they want to, maybe there are three instead of two, and they want to run an auction. So the idea would be they submit bids, and as in the auction literature, the bids are meant to be private. There are abuses known about third-party auctioneers basically coaching up, the bids by telling A that B submitted something cheating, but, so this can be run without an auctioneer. And yeah, it's all I refer to as a smart contract. I'm not going to be terribly unhappy if you suggest an alternative. But the smart contract is the code here. It's the code on how to run the auction, for agents to submit bids. The bids get encrypted. It goes to the code, which is the quote auctioneer. The code, though, we've discussed this, Zhiguo, separately, right? That the code is able to, because it's encrypted, do stuff in homomorphic encrypted space, like rank order the bids and tell the participants who is the winner. They could have put value in escrow on a CBDC, in which case, that's going to have to be transferred, and maybe that part gets validated. But the incentives to bid truthfully come from the design of the auction. So third parties don't have to see these messages being sent, that, am I helping?
Hello? No. We your voice coming out.
Okay.
Good.
But I can't hear you.
Oh, really? Fahad, can you hear us?
Now I can, yes.
Okay. Yeah.
So, I mean, again, I guess just to repeat, the contract is an agreement.
Yeah.
If it's done in mechanism design, then it's taking into account the private information, the incentives, the moral hazard and truth-telling constraints. It's all loaded in there from the get-go. So we know from the revelation principle that works, right?
Yeah.
So you write it up in code, let the participants play around with it. They can run simulations. We have that auction, Nicholas and I have that auction running on a notebook. And you can actually see, oh yeah, here's my bid, but I'm keeping it private on my computer. Here's what the encrypted bid is. This is what's going into the code and so on. And so the participants get convinced that the thing works, that it accomplishes the objectives that they had in mind all along. And then you run the thing in real time. There's no need for any further validation.
Whose computer it is? Both of you?
You could, that's a choice. That's a good question. Depends on whether you trust the other guy's computer. You could have a third-party computer. You could run this thing so that it's running on your own internal computer, at least as far as your bids and so on.
See, so it's like an enhanced auctioneer in a way. That the auctioneer, you trust auctioneer, it will not modify the code. Is that the key idea?
I'm getting rid of the auctioneer. I'm letting it all be done with the code. There is no trusted third party.
Okay. But that code has to be stored somewhere. Is that right?
Well, they agree to it, yes, and then it would be secured.
Oh, okay.
But you're right. There are always aspects of trust. I mean, this thing, like you can't. I mean, if you had data and you want to put it in the cloud or something, is it Amazon? Well, then there, is that?
Yeah. Totally.
Yeah.
Okay. Yeah. Good. So I do think that in a way that encryption that it could help quite a bit. I want to mention that to the audience that I do know that there's a version of Ping An that I knew, Ping An One Connect. They're doing similar things on this. Everybody input is encrypted message, and then you have a trusted, that's multi-party computation to spit out things. That sounds like what Rob is talking about, and it seems to be implementable in the practice. Okay, great. Here's one question from Suman. It's a little bit long. If you are still there, let me promote you.
Should I stop my screen share?
Yeah, probably. And where's the Suma? Okay, so let me promote to panelist. Hello, Suman?
Yes.
Good. Yeah, can you?
Yeah, definitely. So
Question again? I'm sorry.
Whenever we talk about private sector and public sector, we talk about private ownership of assets, objective of profit maximizations, and if you have right mechanism, you can generate, maximizing second best solution. But the problem comes when the decisions become very autocratic, even in a private system. And Milgram's kind of says that people have this innate objective, innate tendency to, follow the leaders. And the private, like a CEO who is about to retire, might have these incentives to, do fraud and do things that are not detrimental to the best interest of the sector itself. Have you thought about these kinds of, off equilibrium behavior that might affect the equilibrium? And so when you talk about private sector, we kind of assume away those things. Any thought on this currency like this? I talked with a guy who is a practitioner, and he said the weakest point is the exchanges, where most of the bad things happen. And if we privatize these currencies and allow this, like government type roles, can it have serious ramifications?
Well, I'm glad you're asking the question. I should say most of the slides basically talk about ex-ante optimal design. So it's much in the spirit of what could be done with mechanism design and contracting, as opposed to the other endpoint of the spectrum, which is, we're stuck with legacy infrastructure. We're stuck with the way private sector is behaving. We're faced with runs and we have to either rule things out or regulate. So I'm maybe going a bit too far in terms of, no, it's not a problem because you could redesign the system. So there's a political process involved in moving to better systems. That said, I think mechanism design is quite powerful. I mean, it deals with things like theft and abuse of information now with cryptography and so on. So I think we have the tools to remedy at least some of these problems. And then the issue is the willingness to solve the problems at hand. I mean, there is always a challenge in innovating. There can be losers, right? I mean, the Pareto principle is, in principle, you can compensate because the pie is bigger. But in practice, it is sometimes difficult to do that. And, you know, like commercial banks could all make more money if the pie is bigger in principle, but then, you know, we'd have to agree to let them benefit in that way. They don't like the threat of the competition, and they block and they appeal to the public sector, talking about the security of payments and so on, and only we know how to do this. And they're quite successful at block. That debate is going on very, very actively in the US right now. And you know, take a look at the Bankers Association website if you're not convinced. It's pretty self-serving. But you know, some banks, the big ones too, are also thinking about innovating. So I think innovation can happen. We just need to have the right, more appropriate conceptual framework to think about what we would like to see happen.
Thank you.
Along this line, I think it's a like pending question, which is the regulator are kind of like in my mind, a regulator, like not like a top, right? Regulator, it's kind of sitting in between, no? It's like they were, at least they try to listen to the private guys, know exactly what the private innovation is, and on top of it, also thinking about objectives to maximize, you know, these mass, right? People who typically don't know what's going on. How do you think about the regulator's role, and also that can you comment on recently? You touched on a little bit the recent U.S. CBDC, and you know, feel like a regulator is sitting on the bank side and not at least the fintech side.
Well, it's going to be different in different countries. The U.S. is clearly following a very deliberate path, to put it in as good a way as I can. Many other countries are innovating. Brazil, in particular, has this vision of potentially allowing digital real on top of what they already have, which is a great payment system, because it can serve these other roles that I was delineating in the slide.
The PIX thing?
Well, PIX is an example where they basically somehow got the commercial banks to agree to have a unified payment system, and India is the same. So yeah, there's no doubt an interesting political economy story. My understanding is that the DeFi is the big thing looming on the horizon that regulators and banks are aware of. And so the argument is that if you act like it's not there, you're going to see all this other uncontrolled innovation. And likewise, commercial banks are threatened by it. So better to surrender a bit and allow PIX than to have these walled garden payment systems. The US still has walled garden payment systems, basically. That's back to your, Lucy is an initiative that claims to be able to allow interoperability across diverse payment systems. But we already talked about that.
Great. So time is up. If you guys don't have more questions, I will make sure, Fahad and I will make sure that Rob's slides will be available and online, and also feel like, So okay, I we have a 15 minutes more. I thought it always is a 1 hour. Let's also discuss one question, which is that in a way that I try to this is a save the question, and you can expand it, which is that I see the idea of this given the new technology would be very, very, very rich sense that where the public and the private really gets blurred. I see data, right? Data is very clear. But what is this, like the decentralized technology, which you and I were thinking, like crypto or these things? In what sense that some of them actually help private, some of them help government, and so that we could somehow get a sense that in the next 20 years that where the different countries going.
Well, I guess my take on this is there's just enormous room for improved financial intermediation. That I think that is true in emerging markets, as in Thailand, and you can see that innovation playing out with Alipay and WeChat in China.
If you could elaborate on Thailand's case, that would be useful, because I also didn't know, and I realized that they signed a CBDC bridge contract with Hong Kong. If you knew anything, that would be nice to comment on.
Yeah, so one aspect of Thailand I know well is from the ground up, which is to say, I did those surveys for 20 years, and I have income balance sheet and cash flow statements. So I can actually document the gaps. When I say intermediation is imperfect, it's not an abstract concept. We can look at risk sharing, payments, escrow, et cetera. They have something. The informal sector is quite lively, but it's still limited on certain dimensions. So those things can be remedied with the new technology. This fintech that I mentioned, EveryNet, and Velo that came before it, is an open contract platform that has nothing to do with the public sector per se, but it would allow and is allowing competition in the provision of contracts. Now, that said, there's still a strong temptation to design and innovate where the interest is, and DeFi nowadays is where a lot of the money and interest is. My own view is a chunk of that is pretty speculative, and I would prefer to use the tools that they're creating to move more toward reaching Main Street in terms of small and medium enterprise and so on. Now, I mean, Thailand's a bit of a tale of two cities in the sense that at the sort of level of the central bank introduced me to that fintech, by the way.
They want some intellectual input.
You can read that in a number of ways.
They're smart.
But yeah, at a national level, the central bank has taken the initiative with Hong Kong first, which is sort of MCBDC.
Yeah, MCBDC.
Multiple fiat tokens, and it's largely about value transfers, as in cross-border payment problems. I mean, it uses hash time lock contracts and so on to execute. So it's really great that it's using the technologies. And as you know, United Arab Emirates and PBOC joined. So now there are 4 of them. I'd also recommend looking at Project Intanon and Lion Rock, which is again related, but sort of an interesting take on things. So that's where this language, depository receipts, comes in to play. But basically, each country has its CBDC, and certain entities, commercial banks, are allowed to, take fiat into CBDC and take CBDC into these depository receipts, and then the depository receipts are used in the cross-border transfers, all programmed up with the new technologies. So that's just 2 countries, but it is an interesting vision of,
But it must be that there's some designated, like, banks are allowed to operate it.
only
These-
banks are mentioned. Yeah, only banks.
But only some banks, or only like any bank?
I'm not sure about that. It's a list of the major banks.
Okay.
And yeah, my own preference would be to open it up as well to non-bank financial, but the central banks are used to dealing with commercial banks as so
They
it is
inherited that
natural.
system anyway.
We have to distinguish what they're actually doing in terms of the entities allowed to participate versus what
That's right.
could happen if you opened it up even further. And it's great that they're using this this new technology. So Thailand's innovating on the international front. It's one of the leaders. And I'll just say it's kind of ironic because Lion Rock and Intanon are mountains. They're named after geographic features, and Intanon, that mountain in Thailand, is where I did my original field research in the north of the country back in the 1990s. So micro and macro kind of come together in my mind.
Never been to Thailand.
I'd like to see it happen a little more. Yes.
Yeah. So we have a Coase raised his hand. Coase, can you?
Yes.
You want to ask the
Rob,
question directly?
can you hear me?
Yes.
Yeah.
I have
Very
a
good.
Rob, I have a question. In your framework, you didn't talk much about enforcement institutions, which you need. Of course, contract enforcement is assumed. For example, I was just thinking of how that interacts with CBDC, because in China, for example, Zhiguo talked about China, the bankruptcy systems, although they have a federal bankruptcy system, which is young, people sometimes say it doesn't really work, or it doesn't work most of the time. So my question is, what do you say about the role of legal enforcement and enforcement systems when you do have a CBDC arrangements? Yeah, that's one. And number 2, how important is this notion of decentralization? As you said, it takes away the need for a trusted institution, but you still need to worry about people who default on contracts, breach on contracts, we assume, for example, a well-functioning bankruptcy system. I don't know. That's something I think the central planner or whoever it is thinking about CBDC, they have to think about, enforcing institutions and the importance of decentralization in that kind of a setup. I don't know what you have to say. It's a little, I'm tying up too many things, but I don't know whether you've thought about this.
Well, I would say, in practice, with the systems we have, including legacy financial infrastructure, things have worked out for better or worse over time. So the repo market in the US is a good example of somehow the recognized need to allow exemption from bankruptcy for these repo contracts. The idea being there's a trade backed by the collateral, right? And the collateral is secured. So you don't have to, if there were a bankruptcy, the lending party can still get the collateral without going through the courts. And that is an exception. That's huge. You know, the US repo market is one of the largest markets in the world, I think, apart from foreign exchange. So yeah, in other cases, it's not worked out. I think I would say eventually you would imagine the courts might take a look at some of this. But the new technology allows the intentions of the parties to be made clear.
Yes.
They enter into the contracts, it's all coded, they sign it. If they sign it, encrypted as it may be, it's proof that they are who they are and they entered into it voluntarily. So it's not like, oh, I didn't really agree to that. I didn't know the price was going to move so much. You know?
Yeah.
Escrow, again, is similar, you know, so that deals with some of the problems that come with, you know, limited commitment and so on. But I, you know, I would imagine, since this is all relatively new, and not to say I would encourage this, but someone who feels they got the worst of the deal might, you know, try to petition to the courts. And I don't, Zhiguo, do you know if there's any legal precedent for, you know, adjudicating these kinds of claims?
It's always lagging behind, but indeed that I knew that the China court system start to building a centralized database, which is quite helpful, to be honest. Like the first thing you would do is at least within a county that all these data are putting together. I slightly disagree about Rob's saying that, oh, you know, with these digital whatever, it's a smart contract or fancier way of writing contract that could resolve the issue that people say, oh, I didn't understand. That if you make it even more complicated, I thought that often the time people will even have a more excuse to say that, oh, I didn't understand the true intention of these contracts. That to me, it's a very separate issue, right? At this point, you and I are still debating on what is a smart contract could really are doing, and I can feel like maybe that could be a little bit of an issue that for some other people.
Yeah, Rob, I think the nature of the litigation might change, but I think there could still be ex-post regret and litigation and things like that, you know, which is sort of what Zhiguo is saying, you know. It might, the venue for it or the exact provisions on which it is litigated, that could change, which might be a positive thing, as you said, you know, because then you're already assuming that. But, you know, the legal system has to kind of come up to it that, you know, how do we...
Well, I agree, even in part with Zhiguo's last comment, but I can imagine a role for consumer protection here, but not to kind of thwart the innovation. That's the worry I have about those kinds of concerns. But I don't know, maybe we're in this territory of small value, large value. We certainly don't want small retail customers to enter into arrangements that they did not understand. And so I'm not trying to ignore it. In fact, back to Thailand, you know, I spent quite a amount of time designing my own version of better cash flow management and life cycle planning and so on. And I know the difficulties of conveying. It's not a classroom setting, you know. But I'm making the point that I think these things can be faced directly. But what I resist is the things like, crypto is bad, Bitcoin is terrible, consumers are going to be duped, let's just outlaw it altogether. And you hear those arguments.
No, yeah.
The policymakers are incredibly ill-informed in general, with many great exceptions, about what this new technology can do. So maybe I'm coming in a little bit strong in terms of promoting the technologies through the lens of applications and economic theory.
Well, thank you. So we have a last question from Joe, which I think it's perfect to end this this discussion. Joe, can you ask? Thanks.
Yeah, thank you very much. It was a great presentation, very informative. I'm really glad I attended, although I think I'm in over my head. My question is, if these private sector initiatives are successful, should we consider regulating profits to prevent the enormous economic rent pattern that the banks have demonstrated? Their profits, their sales, et cetera, have grown much faster than the economy over the last 40 plus years. How can we avoid that again? Thank you.
I agree. And that's a version of this big tech problem, right? I mean, you see the innovation happening, and arguably it can benefit clients and small businesses and so on. But the worry is that somehow the first one or two innovators that jump in get to be oversized, and because that has to do with the data, like take Google and so on, and Amazon, and that regulators think about breaking them up or so on. I'm all for data restrictions, but it has to come from thinking through, whether data should be public or private. That's the encryption part of it. Now, again, I'm swimming upstream because we already have these legacy, Amazon, et cetera. So it's hard to go backwards. But on the other hand, the policymakers, even yesterday, are moving again in the US to restrict them. So if we're going to start thinking about antitrust or products, then we ought to think about it with a clear head, if possible. So I agree with your concern. There's a danger that we'll just replace one kind of abusive intermediation with another. We do have the tools to prevent that from happening, and we should use those tools.
Thank you
Thanks,
very
Rob.
much.
Thank you. So we are done today. Thanks for attending. Our next workshop seminar will be on September 16th, 11 a.m. Eastern Time, as usual. The topic is DeFi, front-running incentives, and cyclical arbitrage. So, stay tuned. Just check your email on these things. Thanks again, Rob, and thanks to Fahad to ask me to host this session.
Thank you.
Thank you.